What if I told you that downgrading from a new car to a used one could save you $230 every single month? That's $2,760 a year just on loan payments alone. But here's the catch. Used cars come with hidden risks that could erase those savings fast. In this video, we're breaking down the exact math to help you decide if a car downgrade makes sense for your wallet in 2026. Let's start with the numbers. According to LendingTree's Q4 2025 data, the average new car loan is $43,582 with monthly payments of $767. Compare that to a used car. The average loan is $27,528 with monthly payments of just $537. That $230 monthly difference adds up to $2,760 per year. But here's where it gets even better. Over the full loan term, 69 months for a new car versus 67 months for a used car, you'd pay approximately $52,923 for a new vehicle, but only $35,979 for a used one. That's a difference of nearly $17,000 before we even factor in interest rates. And that's just the payment savings. When you add in lower insurance costs, reduced depreciation, and cheaper maintenance on a used car, your total annual savings can hit $3,000 to $7,000 depending on which vehicle you choose. The math here is pretty compelling. But, and this is important, downgrading isn't risk-free. Used cars are less predictable than new ones. New cars come with manufacturer warranties covering 36 months and 36,000 miles, meaning major repairs are free. Once a used car hits 60,000 miles, you're exposed to some real costs. We're talking brake replacements between $500 and $1,500, transmission issues that could run $2,000 to $4,000, or engine problems up to $8,000. These bills can wipe out years of savings if you're unlucky. Here's the good news. If you focus your downgrade on vehicles that are 2 to 5 years old with clean service records and under 50,000 miles, you significantly reduce this risk. Buying from reputable dealers or private sellers with verified history reports also matters. The key is being strategic about which used car you choose. So should you downgrade? The answer depends on your specific situation. Financial advisors typically recommend keeping vehicle costs below 15 to 20% of your gross monthly income. If you earn $5,000 a month and your car payment is $900, you're spending 18%, above the healthy threshold. That's a sign you bought more car than you can afford. According to recent data, 2 in 5 drivers spend 20% of their monthly income on vehicle costs, including loans, fuel, insurance, and maintenance. If that's you, downgrading isn't optional, it's necessary. You should also consider downgrading if you have less than 3 years remaining on your new car loan, or if you're thinking about buying a new vehicle when a used 2 to 5 year old alternative is available. These are your green lights. If you've decided to downgrade, here's your roadmap. First, determine your current vehicle's fair market value using kbb.com or NADA guides. Input your mileage, condition, and location. Next, subtract your outstanding loan balance from that value. If you get a positive number, you have equity to work with. If it's negative, you're underwater, and we'll address that in a moment. That number is your starting point for the entire downgrade strategy. Then, decide whether you'll finance or pay cash for your next vehicle. If you're financing, figure out what monthly payment you can afford without exceeding 15% of your gross income. Run the numbers carefully here. This decision will determine whether your downgrade actually improves your financial life. Want to see the complete step-by-step breakdown, including how to handle negative equity and detailed comparisons between new, used, and downgrade vehicles? Head over to the full article at wealthwire.com. The link is in the description. And if this video helped you think through a big financial decision, consider subscribing for more grounded personal finance content that actually uses real data. Thanks for watching.